Hey, good morning and welcome back, everyone, to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. And we are at this week at a pretty pivotal junction with regards to where equities sit. Um, we've pulled back to a major support level, and these are levels that the bulls have to maintain in order to maintain a bullish market here. So let's take a look at kind of where we currently stand, what's different between now and what we saw during 2016, and how that affects our outlook here for trading. So if you look at the S&P 500, this is the level that I'm referring to. We broke out to a new all-time high. We're now pulling back to that level now as support. Yesterday's price action showed us that we were just about holding that onto that level here and potentially maintaining a continuation of that bullish cycle here. And this is really what we're looking for, is whether or not we finish the week above this important, call it 5,900, or if we crack below those levels. If we crack below, we get back into a much more neutral view of the markets. That, what we effectively got after the election was a bit of a false breakout that's now pulled back into the trading range. Or we can, more confidently say at the end of this week that bulls have maintained control of the market, and using 2016 as a bit of a using 2016 as a bit of a roadmap, where the equity markets rallied between the election and the end of the year. um, that would be our base case here for the rest of the year at the moment. Now, if you look at the NASDAQ 100, we did manage to break back into the trading range here. Um, Now, this very well could be temporary. We can crack back above this level this week. I think a big part of that would be NVIDIA earnings on Wednesday. You also have major retailers uh, um, reporting that'll give us some sense for the confidence of the consumer going into the holiday season. Those are two important, I would say, um, hurdles that the markets have to overcome in order to maintain kind of a more bullish outlook here. Nvidia, if they can beat on earnings or at least meet expectations, would be a big part of that. And then retailers, which would give us some confidence in terms of how the strength of consumers are going into this particular holiday season. You look at the Russell 2000, you broke out above 225. It's coming back to retest this level of support. Looking for that continuation higher here is what equity markets are looking for. RSP equal weight S&P 500, similar to the market cap weighted, similarly pulling back to that support level here, slightly below that, but we could very much end the week where this ends up being higher here. But those are some of the important lines in the sand that we're watching across the major equity markets, for an understanding of who's maintaining control here for the rest of the year. Now, growth versus value, we continue to see growth outperform value by a little bit over the past couple of months after what has been a period of kind of more consolidation, um, where neither growth or value outperformed by much. We're seeing a bit of a return to the slight outperformance here for growth names versus value. Um, we've seen oil and gold tick up a little bit here, which kind of gives commodities a bit more of a sideways kind of consolidation. But overall, as you can see, the trend here for commodities over the past few months has really been more to the downside in terms of that trajectory, even though it's been a fairly volatile move here. You have the 10-year, I'm sorry, high yield corporate bond ETF. As you can see, that pulled back here to the 50-day moving average so far has resulted in a bounce off of that level as support. This is definitely an important one to pay attention to, because One of the biggest differences I would say between the equity markets today and 2016, the last time Trump won the election, are interest rates. You have 10-year yields, back around 4.4%, after reaching as low as 3.8 just just a few months ago. It's a higher interest rate environment, and at the moment, between the inflation data continuing to be a little stickier than kind of what some investors would have hoped for, the relative strength of the US economy, which has led Chairman Powell to take a more hawkish tone here with regards to his rate cut expectations. And then you combine that with what is perceived as policies that are more inflationary in nature with the incoming administration, with tariffs and trade and tax cuts. These are generally viewed as inflationary. It's driven interest rates substantially higher since the election. And that provides a bit of a headwind here for equities. And I think that is always going to be the biggest drag here, potentially on equities versus what we saw back in 2016 going into the end of the year. Now, high yield corporate bonds, after pulling back to that 50-day moving average, bouncing higher is slight vote of confidence here that the bond markets are not as concerned about the rising yields and what that means for from a credit risk perspective, which would be a risk on signal here for equities. So that's kind of what we continue to see here, and we'll continue to monitor that to see if there are any changes from that perspective. You have the VIX trading at around 15, 16% now, after it was trading around 22 prior to the election. From my perspective, reflects a bit of perhaps a bit of complacency from equity investors. We're heading into a season where analysts are starting to revise EPS targets for the S&P 500 for next quarter. And we're seeing more negative revisions than positive revisions. Um, that really speaks to one of two things. Either analysts have gotten this correct, and we're going to start seeing some contraction in terms of EPS growth for the S&P 500, which is something that we haven't seen since 2020. And I would say that the EPS contraction in 2020 was a bit extraordinary in terms of why that happened, due to government shutdowns, across the nation, globally. This is a little different. This is slowed down because of actually slowing down from revenues and EPS growth. And the fact that we're trading at 22 times forward earnings, uh, gives some significant downside if we do start to see EPS taper off here for the S&P 500. The other side of this equation is, as analysts slash EPS expectations, they are a little too pessimistic, and that these companies are fine and continuing on a strong path of EPS growth. And if that's the case, markets probably will continue to rally because the bar has been set so low on the next earnings season. But regardless, this really speaks to an environment where it favors for options traders to be long volatility, long complex convexity, long calls and puts into specific catalyst events like earnings. Calls obviously on stocks that you think are bullish on, puts on stocks that you're more bearish on, or stocks that you think will miss on earnings. It presents more trading opportunities for single stock, as dispersion kind of increases, as there are more scenarios of stocks moving higher and stocks moving lower, even if overall, the equity markets aren't moving so much, as they kind of reflect, or rather, the indices reflect more of an average of these stocks. but the individual stocks themselves see a fairly large percentage of movement in the underlying itself. So with the VIX kind of lower in this 15% range, I do think that we are now entering a territory where it makes more sense to be long volatility, long calls, long puts, long debit spreads on individual stocks going into the kind of the next earnings season. You have the 10-year yield recently finding a little bit of a reprieve here, grinding back down around 4.34% here. But as you can see, overall, the ascent here over the past a couple of months have been pretty steep, going from 3.6% all the way up to 4.5% just a couple of trading sessions ago. So the fact that we pulled back to 4.3 is constructive of potentially starting to reverse that trend here, and we'll see if that can continue. We've obviously have TLT kind of finding support around this $90 area here. The sell off here certainly gets bonds oversold and looking far more attractive here than equities. And especially at that 4.3, 4.4% range, from a valuation perspective, from a valuation perspective, in multiple ways of measuring it, bonds look more attractive here right now than equities. So um, the fact that we've gotten back into that 4.4 range simply makes bonds a little bit more attractive. Now, the dollar index did manage to rally all the way up to that 107, which is a major resistance level going back the last few years. So this is a very spectacular run from 100 to 107 in a very short period of time. And generally speaking, after such long periods of strong outperformance, one directional move, we tend to get a bit more of a sideways action. And I think that's what we're going to get here over the next couple of weeks, around between 106 and 107. And we'll have to see kind of where it breaks out of that range over time. But at least in the short run, our base case is that we see more of a consolidation here going forward in this 106, 107 range. And then looking at kind of what has moved, we saw gold bounce off of that 2600 support here, or 2550 support here. This is a pretty significant pullback here, about a nearly $300, $250 pullback here in gold in just a couple of weeks. So gold finding a little bit of support here. And that's why we've seen kind of commodities bounce a little bit. We've also seen oil bounce a little bit off of that $67 kind of you can call it a quadruple bottom if you want to, of that specific level, and we'll see if that can hold here or if this is just a bit of a bounce that kind of ends up retesting 67 and potentially breaking lower. We certainly are entering an environment where the demand for oil continues to remain fairly soft relative to the supply. So unless we see more of a cut from OPEC nations, I think that you could potentially continue to see oil grind lower here, even below $67 a barrel for West Texas Intermediate. And gold, gold demand remains fairly insatiable here. So that can very well, the pullback that we've gotten is the consolidation that we typically see after such a strong run on gold. So we could see a bit of consolidation going forward here in gold. And looking at the sectors here, there's a few sectors that I think are worth paying attention to. The first one is the fact that technology sector, has really failed to break out to new all-time highs with the S&P 500. That's something to be aware of because tech was a strong sector in 2016. Going into 2017, we're not seeing that here right now. The Magnificent Seven have not particularly been performing well, and that's part of why we've seen that those seven stocks drag on the S&P 500. We obviously expect NVIDIA to report after the close tomorrow. That's going to be a main driver of potential yeah, potential driver of this particular sector. But at the moment, outside of NVIDIA reporting, we've seen kind of the Magnificent Seven really lag behind here. So this is one that I think is worth paying attention to. You have consumer discretionary that continues to outperform by a pretty significant margin here over the past few weeks. This is, call it a bit of optimism going into the end of the year. We have Walmart, TJ Maxx, Target reporting this week. That's going to give us a better glimpse into what those companies have in terms of outlook for the holiday season. I think that's going to be a main driver of sentiment here after those announcements come out. You have communications outperforming by a pretty significant margin here to the upside. You have financials outperforming quite a bit to the upside. More so from a regulatory perspective. Obviously, higher interest rates generally help financial institutions to some degree. Those rely on net interest margin. However, I would say that the rally we've seen in financials is probably due to a little bit more of optimism around that the incoming administration will cut down on regulatory um, burdens for some of these major financial institutions, and that's providing a bit of a boost here to those potential bottom lines going forward. Um, we continue to see healthcare underperform. This is also potentially due to the perception of what the incoming administration will do to potentially tackle, call it the pharma industry. There certainly are some concerns as far as what someone like RFK Jr. would do to the pharma industry, and we've seen kind of those stocks with a relatively heavy exposure to vaccines, take a bit of a hit like Pfizer, Johnson and Johnson, and that's going to continue to pressure the healthcare sector to underperform. You have materials and industrials kind of lagging behind a little bit. You have energy outperforming here, and this is probably a bit of a head scratcher when you see oil prices, near 52-week lows. And I guess this is also due to the perception that the incoming administration will be cutting regulatory red tape in this particular industry, and that's why we've seen oil stocks rally, despite the fact that oil stocks, or oil prices themselves are pretty much near those 52-week lows. And then we also have seen home builders continue to struggle here. This is more of a view here, I would say, on interest rates. The fact that mortgage rates remain incredibly high means that um, even though that inventory is relatively low, home building is not at a particularly fast pace here. And then probably more concerning here is really kind of the semiconductor industry. We've seen semiconductors break below a major support level on an absolute basis. We've also seen it break below on a relative basis. So that's a pretty weak outlook here for semiconductors going forward. And like I said, outside of NVIDIA, the vast majority of semiconductors have failed to, reach new highs. They're actually starting to reach new lows, and that's a big concern here um, for stocks going forward. So let's take a look at some of the ideas that we have here for this week. Some of the new ideas that I want to share with you is kind of related to that last chart that we showed you, the semiconductors chart. ADI, so analog devices. This is a semiconductor stock that has continued to struggle here over the past few years. And this is one that I think is worth paying attention to because As you can see the chart here, we've kind of broken down below some major support levels around 215, 220 or so. The fact that we've broken down below that major resistance zone with underperformance leads me to believe that even if there's a little bit of a rally here, that those rallies provide more of an opportunity to add some bearish exposure. And ADI trades at a pretty significant premium relative to its industry, nearly 40% premium relative to its peers, despite the fact that it's not growing any faster than its peers. It's not more profitable than its peers. It's actually slightly less profitable than its industry median. So for those reasons, the fact that it trades at about a 40% premium relative to its peers leads me to believe that there's some significant downside risks here to a stock like ADI. Next one I want to take a look at here is Adobe. We've been looking at Adobe here after it's kind of pulled back a little bit and reached somewhat oversold levels here on both daily and weekly time frames, which kind of gives us that kind of opportunity for this to start outperforming here. Adobe is a stock that we continue to like within the AI kind of space. They are one of the few AI products that actually has a real product that they can monetize and sell today. And their subscription business to their creative tools has been a primary driver of growth here. They're expected to grow either in line or exceed their industry average. They are far more profitable than its industry average, yet it trades at about a 10% discount relative to its peers. So this is one that I think that the upside is also fairly substantial because of that pretty big disconnect between kind of the growth and profitability metrics and its valuation, which currently trades at a discount relative to its peers. And I believe that it probably should trade at a slight premium. We had a couple of pharma companies in our bullish views, but that I think right now we're going to take a bit of a step back on and kind of better understand the landscape for that particular industry before we reiterate some of those views. At the moment, Apple is one that I think is worth paying attention to this week, especially with retailers going to provide us with a bit of an outlook here for the holiday season. I think Apple, historically speaking, from a seasonality perspective, the last quarter is always their most important quarter for the year. They haven't had a particularly spectacular year on iPhone 16 sales. They've struggled a lot in terms of China sales. India has now particularly made up for all the losses they've seen in China. And that's part of what's been dragging on Apple's stock price. And then, and then to mention on top of that, what was meant to be Apple's next big product release and next big kind of next big product that they're gonna lean on, after the iPhones, considering now that the iPhone sales have kind of to some degree stalled, upgrade cycles are happening at a slower pace. Apple Intelligence that was meant to be aligned to the new iPhone 16 that was going to drive upgrades have been incredibly underwhelming in terms of where they are with AI and how far behind they are. They are playing catch up. And they are, quite a few versions behind here right at the moment where it feels almost impossible as far as how and when they're going to catch up. So for those reasons, I think that the outlook here for Apple doesn't look particularly strong this quarter unless they can manage to turn iPhone 16 sales around, especially with some more updates from an Apple Intelligence perspective. But we're already nearly halfway through the quarter. I haven't seen any evidence that iPhone 16 sales have started to pick up here. Apple Intelligence reviews continue to be incredibly underwhelming. And then you have Vision Pro, which is kind of meant to be their next big product line that's going to start offsetting some of the declines we've seen in revenue for the past few years. They've slashed sales expectations multiple times this year already. Developers are not developing for that particular product, which makes it virtually dead in the water if developers are not developing for it. This is a product that Apple sunk nearly 10 years and over $100 billion on. That's no small change, and this is not just something that is experimental. This is very much where they've put a lot of their focus on. Yet, I think companies like Meta is potentially further ahead within augmented reality, both in terms of hardware, in terms of use cases, developers, in terms of apps. This is really where Meta has a bit more of a mature ecosystem, from their VR experience that they've had over the past few years. So there's a lot at risk here for Apple. There's a lot that they can potentially lose. So for those reasons, that the fact that Apple trades at 30 times forward earnings, which is a 50% premium relative to its peers, it's not growing any faster than its peers. Yes, it's a little bit more profitable than its peers, but it's not enough, in my opinion, to justify a 50% premium in its valuations. And I think that represents the downside risk that we see here with Apple here at the moment. Um, So a couple of retail stocks that we continue to like, Lululemon, continues to grind higher here. We're kind of formed this bit of a channel here. We've pulled back. I think that represents a potential opportunity to get long here with Lululemon. We also like Block, or what used to be Square. As you can see, we recently just also broke out here above $88. We've brought this trade to you the last few weeks, when it was trading in that $72 range here. We've broken out here now above 88. So this is starting to trade into the next bullish cycle here for Square. We also have taken a bullish view here on Intel. And so far, this $24 level here has been holding, which has been a major support level here. As you can see, it bottomed here below 22, completed this bottoming formation, broke out above 22, consolidated for quite some time, now broke out above 24 and is now consolidating above 24. And we're looking for that continuation here, at least into that 28.5 level here, which is the gap fill. That would be our initial upside target here. And then above that, we're looking at closer to roughly $34 here. So 28 and change and 34 are kind of your upside targets here for Intel. And then Disney and Shopify are also two of our trades that we continue to reiterate. Disney recently reported earnings here. So we've been talking about the stock when it was in the low 90s. So now that we're trading around 113, which was kind of our initial upside target here, filling up that gap fill, that's been filled. Our expectation is now into that 122, 125 range here to the upside for Disney. And then Shopify, which is the last of our bullish names that we have on our list, also recently reported earnings, broke out above kind of that 52-week high, gapped up higher here around 105. This could, continue to pull back here into that $92 range, but as long as we remain above 92, those are opportunities to look for continuation here for this stock in the long run. So hopefully that gives you a good wrap up of kind of where we currently stand, what our views across the board from equities to bonds to commodities stand, the sectors, and some ideas to help you out for the week. With that, I hope that this helps get you started, and I will see you here next week. Thank